I greet you, ladies and gentlemen, as I commence this lecture, which I believe is the last lecture in this module, save for some e-handouts that I'm going to send via email. But this is the last major topic that I'm going to cover for this module, Central Banking and Monetary Economics. And for those that I'm taking for Central Banking and Monetary Economics, please note that tomorrow morning I'm going to send an assignment. I'm going to post an assignment on our Google Classroom portal. So I don't want to waste a lot of time. I'm going to start the coverage of the lecture. So what we want to cover as the last theme of this course outline is the foreign exchange market and the interest rate determination, or rather want to cover the foreign exchange market dynamics. Want to cover foreign exchange market dynamics. So we'll start with the definition of a foreign exchange market. That it is a market in which various national currencies are bought and sold. It is also called the FX, Forex, or currency market. It has got so many names. Sometimes it's called the FX, standing for Forex, the shortcut for Forex, or Forex, which is the truncated version of the word foreign exchange, or just the currency market, because it's currencies which are sold as commodities in that particular market. It's the largest market in the world, with daily transactions exceeding 6.6 trillion as of 2019. I'm quite sure that in 2022, the figure is far much higher, notwithstanding the fact that the world is just emerging from COVID-19. So the transactions take place in many centers across the world: New York, London, Paris, Zurich, Milan, Tokyo, Hong Kong, Singapore, Sydney, Frankfurt, etc. So financial centers, they function as anchors of trading between different categories of buyers and sellers. The sun never sets over this foreign exchange market. The buying and selling takes place round the clock, except on weekends, because at any given time, it will be daylight in another part of the world. So trading basically takes place throughout the world. And the major centers are those that are listed in bullet number 4, with New York being one of the leading centers. New York, Hong Kong, and so on. The main actors in the foreign exchange markets are the central bank, which is the lender of last resort. And you have got brokers who arrange foreign exchange between banks. They arrange foreign exchange transactions between banks. And then you have got commercial banks, which deal with primary dealers. And then you have got exporters, importers, migrant tourists, the primary dealers, and the non-bank financial intermediaries, and the multinational companies or corporations. So that's the diagrammatic exposition of the main actors in foreign exchange markets: your central bank, your brokers, your commercial banks, and your commercial bank or banks, exporters, importers, and so on, non-bank financial intermediaries, and MNCs, which are multinational corporations. We have already covered the bit on this market operating around the globe. It is truly a global market. Currency transactions, in most cases, they occur almost instantaneously because of electronic channels of communication, and also electronic channels of forex trading. I've already covered the bit on the market being the largest market on earth, with daily transactions of 6.6 trillion USD as of 2019. There is no market which is of this magnitude. In 1998, it was the daily transactions volume was 1.7 trillion USD. 2010, it was 3.98 trillion USD. 2013, it was 5.3 trillion USD. 2019, 6.6 trillion USD. It has got features of a perfectly competitive market, though central banks from time to time intervene to prevent exchange rate overshooting and other foreign exchange market related problems, which may destabilize the macroeconomy or other sectors of the economy. The UK ranks first according to the information of 2013. You can look for the information of 2022 because this is old information, almost 10 years old. And then the UK is followed by the United States of America, and then Singapore, then Japan, and then Hong Kong. So the UK has got the lion's share of 41%, followed by the United States of America, 19%, and then 5.7% for Singapore, 5.6% for Japan, and 4.1%. The four major currencies which are generally accepted are the USD, the Euro, the Japanese yen, and the Great British Pound, which are also called vehicle currencies. These are the most traded currencies. One needs for foreign exchange to pay for imported goods or services. To pay for imported goods or services, I just want to correct a typo there, which are generally accepted. And to correct another typo, lender of last resort, I cancel that dash. And New York is repeated. We have San Francisco, written properly then. San Francisco. Delete that F. When one wants to make investment abroad, they need Forex. one wants to buy foreign financial assets, you need Forex. If you import goods from the United States of America, you have to make payment in US dollars, or even in other countries, because the United States dollar is a reserve currency. Arbitrage, we want to cover certain activities that take place in foreign exchange markets. Arbitrage refers to the economic force that keeps the foreign exchange market from being a single market. The functions of arbitrage, we have the transfer of purchasing power, the provision of credit for foreign trade, hedging against the risk, and so on. All this takes place within the context of the foreign exchange market. We know that arbitrage, the classic definition of arbitrage, is buying a commodity where it is cheap to sell it where it is expensive, so that one is able to make riskless profits. The exchange rate between any two currencies is determined by the forces of supply and demand. That is, if we don't have a fixed exchange rate regime, we're assuming a flexible exchange rate regime. So if we take demand and supply of currency, we get the price of foreign currency in terms of domestic currency price quotation system. If we take demand and supply of domestic currency, we get the price of domestic currency in terms of foreign currency, which is the volume quotation system. So the price quotation system is when we analyze the determination of the exchange rate in terms of the demand and supply of foreign currency, expressed in terms of the domestic currency. But if on the flip side, we take the demand and supply of the domestic currency, expressed in terms of the foreign currency, we get the volume quotation system. The demand for foreign exchange is a derived demand, because people demand Forex to pay for imported goods, to pay for services like to travel to other countries and for hotel accommodation, to visit a foreign country or to invest abroad. The supply of foreign exchange, goods exports, service rendered to foreigners, shipping, insurance, etc., tourist arrivals, and foreign investors or foreign investments, all these, they account for the supply of Forex or the arrival of foreign currency from other countries. And then we want to look at the difference between the spot rate and the forward rate. These two terms are very important, even when we look at interest rate determination. They are also important in understanding the dynamics of foreign exchange markets. A market on the spot exchange of a currency is called a spot market, or for the spot. Let me just correct that. A market for the spot exchange of a currency is called a spot market. Spot transactions are transactions that require a spot delivery of currencies, like the currency has to be delivered today. It's not that it's actually delivered on the spot literally, but it has to be within the shortest possible period of time, which may be a few hours or even the following day. The rate applicable in the spot market is the spot rate, the foreign exchange rate. The name is misleading because under normal circumstances, 2 days or more may be required to clear checks and other financial instruments that are used to convey purchasing power from one economic agent to another. The forward market is a market for forward transactions. A forward transaction involves an agreement between two parties called counterparties to exchange currencies at an agreed rate on an agreed future date. So the rate is agreed today, but the time of the execution of the transaction is at an agreed future date. But the agreement is reached today. So that's a forward transaction. So in the present, there is no currency which is exchanged. The purpose of a forward transaction is to sort of lock in a particular rate to avoid exchange rate risk, which in turn may be linked to other types of risk, such as maybe, your credit risk and so on, or even political risk. The forward market, it deals with exchange rate risk or the exchange risk, which is the possibility of loss due to unfavorable changes in the exchange rate. How about speculation or hedging? An average economic agent is risk averse. There are very few economic agents who are risk loving. So when someone is hedging, they will be avoiding exchange rate risk by equating assets and liabilities in the same currency. That is, in order to have a zero net position, which is equal to an open position. Hedging is equalization of assets and liabilities in the same currency. So assets in USD are equated to liabilities in USD, which means to have an open position. And then if assets are greater than or equal to liabilities, this means one has a long position. And this is normally done by speculators. And the kind of risk that one will be exposed to, it's a risk which is called the long position risk. So if I've got more assets than liabilities in terms of currencies, maybe currency futures, if I've got more assets than liabilities, then in foreign exchange markets, I'm said to be having a long position and I'm exposed to long position risk. Speculators expose themselves to long position risk from time to time. But if on the other hand, assets are less than liabilities, in terms of when we're looking at assets, we're talking about foreign currency related or currency related assets. If they are less than or equal to liabilities, then we've got a short position. It means the speculator has exposed himself or herself to the short position risk. They would have exposed themselves to the short position risk. An agent who has to make payments, they buy currency in the forward market. The options which are available to settle future liabilities are: number one, to buy forward a particular currency so that one is able to settle a future liability and when it becomes due. Number two, to pay now. But if someone pays now, they lose interest. It means you can't invest that same money in order to earn an interest. 3, you buy spot investment till you need the funds, which is called spot covering. Those that I was covering, the points that I was covering are the scenarios which are faced by an agent who has to make payment, who has to make a payment in the future or to settle future liabilities. But the contrasting situation is of someone who has to get a payment or someone who will get a payment in the future. They sell forward. Instead of buying forward, like the person who has to make a payment in the future to settle future liabilities, this person sells forward. Number 2, they allow discount to the debtor for paying early. So if someone pays early, they give them a discount in order to, to be better placed to resolve the issue of assets and liabilities mismatch, especially when it comes to short-term, liabilities. You may have long-term assets, but then short-term liabilities, which means you must have short-term assets to deal with short-term liabilities. Otherwise, you will face liquidity problems as a company or as a corporation. 3, you borrow from a bank and invest. The decision is on the basis of cost and benefit analysis. And then next, before I adjourn this lecture, I want to cover some basic terminology which you might have encountered when you are doing advanced international banking. A forward premium is a situation in which the forward or expected future price for a currency is greater than the spot price. So if the forward price of a currency or for a currency is greater than its current price, its current exchange rate, then we've got a forward premium. It is an indication by the market that the current domestic exchange rate is going to increase against the other currency. This situation is normally confusing to people who are not well versed with terminology, the terminology of international banking, international finance, or monetary economics, because an increasing exchange rate means the currency is actually falling in value or depreciating. Now, if the forward rate of a currency is below the spot rate, it is said to be at a forward discount. Let us assume the spot rate between the USD and the Rand is 1:15. That's the rate which is prevailing these days, 15 point something or 14 point something for 1 USD. If we can take that as the spot rate, and then the forward rate is 1:13. Then we will say the forward rate of that currency is such that we've got a forward discount. Because for a single USD, in the forward market, you are getting fewer, or you will get fewer runs compared to this situation which is obtaining in the spot market for these two currencies, two or more currencies. Just that my example, I'm just using two currencies. if the forward rate is higher than the spot rate, it is said to be a forward premium, which is what I just defined on the first bullet there. In terms of exemplification, this scenario is a scenario in which, say, the exchange rate between the USD and the South African rand is 1:15. And then the forward rate is going to be 1:15.5. Then we can safely say the forward rate is such that we've got a forward premium. We have a forward premium. And in this case, the currency of reference happens to be the USD. So we recall on this slide number 23, that a forward premium is a scenario in which the forward or expected future price for a currency is greater than the spot price. A situation where the future exchange rate, which is agreed today, is greater than the current exchange rate, implying that we are banking on the domestic currency increasing against the other currency. In this case, the domestic currency would be the South African rand. If we expect it to depreciate, from 1:15 to 1:15.5, then we say the rand is trading at a premium. A forward premium is frequently measured as the difference between the current spot rate and the forward rate. So it is reasonable to assume that the future spot rate will be equal to the current futures rate. So there's a futures market, which is a derivative market for the currency market. So just like any other commodity, currencies also have futures and options. They also have futures and options. We know in the grain market, you have got futures and options as well, in order to hedge against the risk. People like to hedge against the risk when they participate in international trade, especially because of the uncertainty and the internal and external shocks that occur in global markets. So according to the forward expectations theory of exchange rates, the current spot futures rate will be the future spot rate. So I think it's simple. The current spot futures rate, where these derivative financial instruments called futures for currencies, their current rate will be the future spot rate. This theory is rooted in empirical studies or studies of empirical finance, and it's a reasonable assumption over a long-term time horizon. Typically, a forward premium reflects possible changes arising from differences in the interest rate between the two currencies of the two countries involved in foreign exchange markets. So interest rates come into the picture because they affect both short-term and long-term capital flows in the world economy, in international finance. So foreign currency exchange rates, forward currency exchange rates are often different from the spot exchange rate for the currency. Why? If the forward exchange rate for a currency is more than the spot rate, then a premium exists for that currency. A discount happens when the forward exchange rate is less than the spot rate. That is, if we expect the domestic currency to appreciate. If we expect it to depreciate, then we're talking in terms of a premium. If we expect it to appreciate, we're talking in terms of a discount, because we'll be trading the domestic currency vis-a-vis a hard currency like the United States dollar with fewer units. So we consider the following example. We consider the following example of an exchange between the Japanese yen and the United States dollar. And we postulate that the 90-day yen to dollar rate, which is a forward rate, is also given. The forward rate of 109.5 to the USD, it's a 90-day yen to dollar forward rate. The same applies to scenario number 2, where the forward rate is 110.5 and also 110.5 for the third scenario. But the spot rates, they differ, as you can see. In the first scenario, the current exchange rate, before we commence counting these 90 days, it is 109.38. It means today the exchange rate between the USD and the Japanese yen is 1:109.38. And the spot rate for the second scenario of a forward rate of 110.5 is 109. The spot rate is 109.5. And then for the last scenario, when we are given a forward exchange rate of still 110.5, the forward rate is 110.38. So what is required is for us to calculate the annualized forward premium, is to calculate the annualized forward premium. That's what is required. Yeah, so for today, I'm going to end at this point. So what I'm going to do in the next video, is I will be demonstrating how these calculations are done, how we calculate the annualized forward discount. So I'll start from slide number 25 going forward. We looked at interest rate parity and so on until we finish this lecture. So for today, or for the time being, I've covered enough content. In the next video, I'm going to resume from slide number 25, where I will be demonstrating how you calculate the annualized forward discount for each of these scenarios. And then I'll be commenting on the answers that we'll be getting after carrying out the simple calculations, which I'm going to demonstrate. So thank you so much for listening in. I will come back in a subsequent video to finish off the set of slides, starting with a demonstration of the calculation of the annualized forward discount. Thank you so much for listening in. We'll meet in the next video.